I think everybody actually wants a weaker dollar. Scott Besson's talked about it. The Chinese desperately need it so they don't have to devalue the yuan against the dollar. As you've said, they don't want to do that. The Japanese would probably quite like it. The Europeans would like it. The Canadians, the Aussies, I mean, everybody wants a weaker dollar, and the US wants one. 2025 is potentially a perfect storm for liquidity, right? All of the chickens come home to roost. Something has to happen here.
One of the most compelling points Raoul Pal makes is that nearly every major global economy wants a weaker US dollar. China, Europe, Japan, Canada, and Australia all have economic incentives to see the dollar depreciate. A weaker dollar provides relief to economies with heavy dollar-denominated debt and makes it easier for emerging markets to stimulate growth without excessive currency devaluation. However, the United States also benefits from a weaker dollar, making its exports more competitive and reducing the burden of its massive debt. Despite this, the U.S. strategically maintains a strong dollar as a powerful negotiating tool.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
But it's fantastic negotiating policy because it's the most powerful throat grip you can possibly have. And so it feels that you get China to play ball in whatever mechanism you've got. And in exchange, you add dollar liquidity into the global system and allow the dollar to weaken. Whether it's, I think the TJ is part of it, but my guess is whether it's swap lines elsewhere, whatever, just to get it into the euro-dollar banking system. And then China is free to stimulate. As you said, it needs to do a gigantic debasement of its own currency, of its monetization of its debt as stimulus. It needs to do that, but it can't do it without losing control of the yuan for the time being. So if the US will give them cover, kind of what happened last time Trump came in 2017. Right. So I feel like there's a game to be played here, and the outcome is the Chinese can stimulate, which was 2017 cycle was no US liquidity, it was all China. Yeah, I mean, the dollar is cyclical. So on a secular basis, because 50% of the world's debts are in dollars, it's going higher because there's always a shortage of dollars. So we get that. Every time liquidity comes out of the system, the dollar goes up. Yeah. But at this point in the business cycle, with the ISM survey still low, China in recession, Europe in recession, essentially, they all have to stimulate because in the end, if China picks up, they buy more treasuries.
Yeah.
Yeah. There's the whole financing game, the state of nations that goes on here as well. Just so people watching this understand why we're talking about all of these is because the dollar is the dominant driver of global liquidity because global liquidity is priced in dollars essentially, right? To me, it feels like 2025 is potentially a perfect storm for liquidity, right? All of the chickens come home to roost. Something has to happen here. And we're in that pause zone. Yes, the TJ may help for the time being. And then really that Trump administration wants it. Maybe it will clear the debt ceiling forever, i.e. get rid of it. And that frees things up and that changes the structure a bit. But I can't help but think within that construct you and I have talked about where everybody has to provide liquidity to monetize this debt, you've also got the Trump administration, which is all about growth in markets. Mm-hmm. And it will not pass their attention that the easiest way to fake the growth in markets is just to continue adding liquidity. A lot of people still saying it can't last, there's going to be a collapse. I'm like, there can't be a collapse. They've taken the left tail out of the risk out of the entire economy because if every time you look to see collateral values falling too much, they just pump in liquidity to stop it happening. So what you've created is this, I call it the greatest macro risk-taking opportunity of all time. Because if they've taken out the downside risk, they're using liquidity to manage it and debase the currency, it makes it a very easy game, which is, you and I would have made more money being on the short side, 20 years ago. And now it's like, it's all on the long side. You're either long or you're flat, and that's it. People have got to stop of thinking of gold price going up and just think about gold as a steady value against all things. And therefore, there's a bit of demand and supply, but really it's the devaluation of the paper currency. So it does its job, as you say. It's never going to make you rich in purchasing terms, because it'll be the same as real estate or even the S&P 500. It kind of just...
It's a hedge.
It's a hedge. But Bitcoin's been vastly different because it's a technology, so it's got an adoption effect as well. So you've got, it's kind of gold squared, which is fantastic because it really helped young people who've got no savings, because buying gold is not going to help them buy a house because it doesn't go up versus houses, because they're both seeing the denominator go down, which is the fiat money. So Bitcoin's been, a kind of savior for people to avoid the debasement effect and actually make some returns. And tech stocks have been the same. The first thing I'm thinking is, obviously we've, breaking down liquidity, the reverse repo is almost drained now, and that'll be drained soonish, which probably suggests an end of QT, because you can see bond market liquidity is not great. And you can see that around the world. There's just not enough liquidity in the system. The gilts market's been a mess, stuff like that. So it feels that they're going to have to end QT as soon as the reverse repo drops. Yellen's made it pretty clear that, even though it's Scott's job now, she's going to have to draw down the TGA until they agree something on the debt ceiling. So that, I guess, is a net liquidity injection that's coming from that. The other thing that I've looked at is, we use forward-looking liquidity indicators of financial conditions, but in the end, the business cycle in the US is still below 50 in the ISM. We haven't even started the upcycle. So it just feels that, I know a lot of people fear a short cycle, but last time around in 2021, liquidity was drawing in March, and it stopped because the business cycle peaked. We haven't even got to we've had the bottom of the business cycle, but you're not seeing the expansion. So I think there is a probabilistic risk that it actually extends into Q1 2026 as well.
While liquidity injections help stabilize markets, they come with the risk of higher inflation. Currently, U.S. inflation remains above 3%, with surveys indicating expectations of even higher rates. If the Federal Reserve is constrained in its ability to cut interest rates, it may turn to balance sheet expansion, essentially reintroducing quantitative easing, QE. Given historical patterns, Pal argues that QE will likely return sooner rather than later, possibly as early as 2025.
Listen, I think we've got until 2030 before the economic singularity arrives. Now, it might not be the exact date, but it's around then. So we have about 6 years to figure out how to unfuck our future. I've put together a report to help you called Prepare for 2030. It's going to help you take the first steps in that journey to make sure you're secure past 2030. As we know, the thing every economy with high debts and aging populations fear is a debt deflation, because the real cost of your debt keeps going up. And the answer is, and has been led by Japan and is always, monetization. There's no other way around it. What are the Chinese going to do? Just let the economy burn to the ground, which is what a lot of commentators suggest. And I'm like, actually, it's the opposite, because the probability is of more and more stimulus to stop that happening.
You're in an environment where you've got monetary inflation, you've got underlying high street inflation in the US already, I think, over 3%, near 3.5%, and that's pretty much what the Michigan survey is already indicating. The expectations of about a week or so ago, that's more or less saying that. So underlying inflation is higher. That may well limit the Fed's room in interest rates, which means there's a lot more emphasis which has got to go back on the balance sheet, which strikes me that the inevitable course has got to be back to QE at some stage, and rather sooner than later. So I think all these boxes are ticked. I think that's absolutely right. But all I'm saying is that I think that's a great way out. I think that the Fed has got to lead on this, and I think China will follow through, very, very quickly because it has to. The question is who fires the starter's gun and when. And it might be that this is 3 months away. It may be that it's sooner. I can't really see it happening sooner, but it could be, we're talking about maybe summertime for this. But what that would mean is maybe there's an opportunity to buy these markets cheaper before they go up again. But all I'm suggesting is there's dangers near term from an air pocket, because the dollar is strong. That's a wrecking ball. The bond markets look fragile. That's a problem. And we haven't really got clarity yet on what the Fed wants to do with its QE policy.
No, although I think we'll be rescued by the TGA. One thing I've used is, and I think you and I have talked about this before, I've used the framework of the 1950s, post-World War II, as this. And we had that same everything code cycle of every 4 years of rolling the debts. And the outcome there was yield curve control, which is, it's all the same thing. And so you run inflation slightly hot, and then you just have financial repression for 20 years, and it gets rid of most of the sins.
But I think the other thing is that what you're seeing is not a flight of capital out of the UK. You're seeing, or maybe Europe, a flight of talent. So I think increasingly one hears stories about, friends of mine have got children increasingly are in Australia or the Middle East, working full time because it's much better environments. And that was unusual. Even 5 years ago, but it's actually commonplace now. So it's happening more and more and more. You hear stories of people that leave London, traders that leave London and go to the Middle East, and they basically are working, in London with sort of a group of, a collective group of different foreigners. They go to the Middle East, and actually they're working among, UK and European persons of their own age, peers, because that's where everyone's moved to. So you're getting this sort of, if you like, offshore center of talent, which is in low tax jurisdictions. And so all the talent is leaving and basically hollowing out Europe and the UK, which are high tax regimes. And so what you're getting more and more in these countries is wealth taxes, because it's really difficult to take your wealth with you. They can control that. And that's the reality. I mean, look at what the socialist government in the UK is doing. And they're struggling to raise money, and they're going to have to start taxing pensions more explicitly.
Beyond macroeconomic trends, Pal points to a growing trend of talent migration away from high-tax Western economies toward more favorable financial jurisdictions. Europe and the UK are experiencing an exodus of skilled workers to places like Australia and the Middle East, where tax burdens are lower. This shift is hollowing out certain economies and forcing governments to rely more on wealth taxation. As a result, investors and professionals are increasingly seeking ways to protect their wealth from punitive taxation policies. Please like and subscribe.